attention was firmly focused on the US election result this week, a result that didn't surprise markets, but the reaction post that election result was indeed quite surprising. We've seen stock markets, particularly in America, fall by around 3.5% in the following few days, and including one big fall, the largest that's been seen over the course of this year. So it may be a case of some travel and arrive, and it may also be a focus on the US fiscal cliff. But the first chart I want to show is a piece of data that came out in Europe whilst all the attention was focused on the US election, which I think just highlighted the concerns that continue to build in Europe. This first chart is the German industrial production chart, and you can see here how this chart continues to show some decline. It resulted in President Draghi, the boss of the ECB, coming out saying that the financial crisis is really getting to the heart of Europe now. Obviously it's been up until now in the focus of the southern European countries, the periphery, but it's now getting to the core, and we're seeing German industrial production numbers, as I say, continue to decline. As a result of that, it was just notable how in Europe, and this was obviously prior to the opening of the US market, that we saw the indexes start to come off. 11 o'clock on that particular morning was when the FTSE turned from positive to negative, and we saw a decline. In fairness, the UK has held up better. I mentioned 3.5% off US markets. The UK is probably down 2.5% this week, and one aspect of that has been the fact that we have a more defensive market over here, less exposure to technology. It is technology that has driven some of the more powerful performances of this year, but we are seeing quite a sharp reversal in some of those leading stocks. Apple is down over 20% now from the peak. It peaked out at $700, is touching $537 now. Still up on the year, still up probably around 30% over the course of the year, but has given up, as I say, getting on towards half of the gains of the last few months. So it's with that technology overroll that has meant that the US markets are beginning to underperform slightly worse than we are seeing here in the UK. So let's just take a look at some of the indices. We're going to start off with the Dow Jones. Here we can see that we've seen a fairly sharp reversal. That 13.5 level, fairly typical for a number of these markets, which have risen very much towards the top end of their trading range that's been seen over the last 2 to 3 years. Seeing a reversal there. The Dow Jones, this is the S&P index. Again, fairly sharp reversal, and as I say, coming back to that FTSE 100 chart, which is just finding it incredibly difficult this year to break through the 5950 level, which it's been hitting maybe 3, 4, 5 times now, and shying away. Hopes still of a year-end rally from investors, but as I say, we're back into the 5775 area. I mentioned over the last couple of weeks that I think that the Europe situation, whilst has taken a back seat towards the US election, it doesn't stop the drama continuing to unfold in Europe, and I'm still keeping a very firm eye on these 10-year sovereign bond yields from Spain. Spain indeed has completed its 2012 financing exercise this week. The auction result that came through, again mainly consisting of shorter dated paper than 10-year paper, went quite well, but these yields increasing again, really from this mid-October point where thought was that they may come for an early bailout and to take advantage of the OMT programme. The fact they haven't has meant that we're now seeing yields rise, and we're getting perilously close to that 6% level. And I think if we do breach 6%, that will be the headline you'll be reading about and cause sort of some concerns. The other major issue that will impact on investors over the course of the next couple of weeks will be what goes on with Greece. It was very much the intention that the Troika agreement to put further funds into Greece will have been revealed by now. It was probably in September they came and said that actually this is probably not going to take place before the US election, because they didn't want any dramas ahead of the US election. Well, we're post the US election and we're still none the wiser in a sense as to when we can expect that particular agreement to come through. So it will just weigh a little bit on sentiment until we can see that resolved. That of course is manifesting itself in the euro. The euro has been quite strong since that Draghi-inspired OMT comment, which was in July. We can see that it caused shorts to cover and a move from the sort of 121 area to 131 against the dollar, where it's hit twice, and we're back into 127.46 at the moment. So the euro has been weaker, and as I say, could be in for a rough 2 or 3 weeks, 2 or 3 weeks ahead. Just turning to corporates, we mentioned recently that we've seen US companies reporting. Generally, the revenue beats have been around about 30-35% of companies reporting have beaten on revenues. In terms of profitability, they're coming through at over 70%. So on balance, it's not too bad. It just means that keeping costs tight at the moment, not investing, is the way that corporates are keeping their profitability up at the moment, much to the frustration of central bankers. We're moving very much into UK and European corporate reports, seeing a few profit warnings at the moment. The one I'm highlighting here is Balfour Beatty, in the construction sector. This is a £2 billion construction group, warning that the UK market has been pretty quiet, actually, of note, and they're now guiding lower for profitability. And I think it's just really just to show the sort of reaction to that the market's clearly not pricing for these negative warnings when they come. So again, stock selection remains key.